topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, it's another great day. Welcome here to Tax Talk for You. Again, hey, connect with us at taxtalk4you.com. You can also connect with us over on Facebook. We enjoy bringing to you topics about taxes. Today, we're going to talk about corporate taxes, partnership taxes, estimated taxes, and why you should be paying those if you're self-employed or maybe if you've got a company in doing business. We're going to dive right into, let's go to the corporate taxes. Corporate taxes are imposed on the net profit of your corporation or business entity by our wonderful federal government and state governments. They're a primary source of revenue for governments. Now, I will be perfectly honest. I've never seen a company that actually pays tax. The taxes are actually paid by the consumer. So when you are buying a product out there, you are actually paying in tax when you're buying that product, because every corporation, whether it's a S Corp or a C Corp, whether it's traded on a stock exchange, has to provide some kind of benefit for its shareholders or owners. And that's passed through either as distributions or payroll or dividends, depending on how the company is structured. So they're always passing the taxes through to you and I. So don't be fooled by making a company pay more in tax. They're going to collect it from you and I anyway. But they are taxed on their net profit. And so essentially, when a corporation is going to generate profits from our operations, whether selling goods or services or other income streams, a portion of that profit is owed to the government in the form of taxes. Companies are required to file tax returns, just like you and I as individuals do. And they've got to detail all their revenue and expenses and resulting profit or loss, and then they pay their tax. Deductions, credits, they have available to them to reduce their taxes as well, and they're going to make very well use of it because they're going to do a lot of tax planning to make sure that they're getting every single tax credit that's available to them that is provided through the law and through Congress. What you first got to do, whether you're a corporation or a partnership, you first got to determine your taxable income. And you're going to start off with detailing out your revenues, what your revenue streams are, whether it's from which products, services, income from leasing or renting out assets, or even sale of assets is all going to be income streams to a corporation or partnership. And they're going to deduct all their reasonable business expenses. And so once you've got those clear figures, then you've got to subtract other business expenses as well, such as employee salaries and wages, the payroll taxes that they pay also for each of those employees, daily operating costs such as utilities, telephone, all those expenses as well. And then your business specific expenses, such as marketing, research and development. There's a wide range of expenses that every corporation is going to deduct out there. And then you're also going to have things that are deductible as well, such as depreciation of assets, and then amortization of intangible assets, such as goodwill. If maybe you bought a business or something, then you may have goodwill that you're going to be amortizing as well for the business. So you're going to be looking at every single business expense. Now, many companies, when you get started, you're going to possibly have losses. And so you may, as a corporation, could have a loss carry forward that you will deduct against your profit when you start turning a profit. And you may have some loss carrybacks as well. It's been provided for in previous tax laws, and that possibly tax losses as well to carry back. Then you've got to also look at what is the appropriate forms to file. So as a corporation, so if you are a C Corp, you're going to file an 1120. If you have made the election to be taxed as an S Corp, now, many small businesses that go in and file with their state and become incorporated, so you may be let's say Taxation Solutions, Inc., you would then file a 1120 unless you made the election to become an S Corp. S Corp is a pass-through company, which means the net profit is taxed at the ownership level. Those shareholders that are into the business and holding shares in the business would be taxed for the net profit, not the corporation itself. That does avoid double taxation. Whereas if you remained a Inc., let's say Taxation Solutions Inc., and you filed 1120, you would be taxed at the corporate level. And then when the company would make what we would call distributions, they would actually be dividends. You would then be taxed again on the dividends that is paid out to the shareholders of that corporation. So S Corp is going to be taxed as an 1120S. And again, it will take all those business expenses out of the income that is derived and come down to a net profit. And that net profit will produce the net income. And then that would be divided amongst all the shareholders. So if you had $100,000, let's say, of net profit and 10 shareholders, each one would get a K1. That would list out of about $10,000 of income on a K1, and then that would be passed through to you as a shareholder. And you would be taxed there with the rest of your income, whether it's W-2 or other businesses or so forth. If you were a corporation as an 1120, you get taxed on that full $100,000 there. And let's say you were in the 20% tax bracket, they would pay $20,000 in taxes. And then each member, if you were doing dividends for the full amount, each one of those 10 members, if you distributed everything, would get a 1099 DIV for $8,000 a piece. And so then you would be taxed again at your tax rate on your personal tax return. So you've really got to look at this, whether you want to be a C Corp or whether you want to be a S Corp. And so there are difficulties in that as well. As an S Corp, if you're working in the business, you've got to be paid a reasonable salary. You should be paid a reasonable salary as well if you're running a Inc. and being taxed at 1120. But that's a whole different topic of discussion out there, is what is a reasonable salary and how should you be paying it for each one of these businesses. Now, we tell you, extremely important So whether you're running this as an S corp or a C corp, bookkeeping, accounting for every dollar that comes into the business and every dollar that goes out of the business. Um, Producing good financial statements helps you run this business on a sound basis. Also establishes you information to know how profitable you are, what's working, what's not working, even. What are the trends in your business? And then providing a balance sheet to go along with that would provide you to help you show the cash flows, help you show what assets and maybe depreciation that you're going to be taking over the next year as well. And so you get a full accounting for your business using bookkeeping, whether you use zero accounting software or FreshBooks. Any one of those is sometimes really good for the business, but using an independent bookkeeper really helps you because you don't have to spend the time doing the mundane data entry and tracking of income and expenses. You have somebody else doing it for you. And so it provides a very ideal situation as you're looking to track income and expenses for your business, and then being able to look at trends. And so you can sit down and look at month to month where you're going. And we're going to take a quick break here. And when we come back, we're going to talk a little bit more about partnerships and how partnerships are taxed and what are your options. We'll be right back after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Getting ready to talk about partnerships and how partnerships are taxed. Now, partnerships can be a general partnership where you just agree to work with somebody else, and now you are partners, and you may set up a DBA out there through your local office out there for assumed names. Or you could possibly be LLC, a limited liability company. LLC, now if you are in partnership or have two members, you are now considered to be a partnership. That LLC can file taxes many different ways, but you've got to select the way you're going to be taxed. So when you're a multi-member LLC, the IRS is initially automatically going to respond and say you are to file a 1065, which is a partnership return. Now, you can make the election to also file it as a disregarded entity and file it as a S Corp or even as a C Corp. Those are elections that you make with the IRS, not within the state. Now, some states will require you to file paperwork with them as well to make the election within the state to become S Corp. And so depending on what state you live in, you would have to look within that Department of Revenue whether that filing is required or isn't, and how they're going to require you to file for your LLC. Now, if you're a single member LLC, you're automatically going to be considered a disregarded entity, and you're going to file your taxes on Schedule C with your personal tax return, unless, of course, you make the election to be taxed as a S Corp or as a C Corp. So those are elections that are available to you as well. But as a multi-member partnership, you're going to be filing the Form 1065. Now, this is going to work very similar to the 1120S or corporate partnerships out there, or corporate returns out there. You're going to be, again, calculating your gross income and deducting all the various expenses that go along with it. Now, instead of filing on 1120S forms, you file, of course, on that 1065, and you break everything down very similarly as you would S Corp. Now, the big difference is you, as a member, owner of the LLC, or a member of the partnership, you're not going to be getting payroll. You're not supposed to be on the payroll itself, to where you're going to get a W-2, or you're going to get, you're not supposed to get a 1099. You're going to get what the IRS puts in there for you as a partner: guaranteed payments. Now, again, this is kind of works the same way as a reasonable salary. What would you pay somebody else to do your job? Now, there's many ways to calculate it. It's a lot of times it's sitting down and saying, hey, what do you do for the business? So part of your job as an owner could be being a secretary, being an admin, being a stocker, stocking the shelves, and of course then being the lead partner or major partner or CFO or CEO. And you can break your compensation down into multiple ways. What would you pay a secretary or an admin or a shelf stocker or a driver? What would a CEO in your position or CFO in your position get paid as well? And that's kind of the way you've got to break down the reasonable salary. The same way we're going to break down, how you're going to take guaranteed payments. Now, those guaranteed payments are going to go on a K-1 that comes to you. Those guaranteed payments are also going to be subject to self-employment tax. So the company doesn't pay its portion of Social Security and Medicare. You pay both halves when the income comes to you on your K-1. So if we take the example where maybe the net income from the business was $100,000, and let's say your salary was normally going to be $50,000, that $100,000 would be after your salary. So the $100,000 would still be divided amongst all the shareholders, but you will see a line on your K-1 that shows your guaranteed payments being $50,000. That's going to come over to your tax return. When you're filing on your personal tax return, your total income is going to be $150,000. It'll be the $50,000, and then your portion of the $100,000, so another $10,000 if there were 10 members in there, just like we did for the S Corp. And now you've got a total income of 60, your 50 plus your 10. And that's the way it would work. If there was only 2 members, you would have 50 plus the 50,000, half of the other 100,000 that was made from the business. Also, depending on how much you guys were paying, maybe each partner for guaranteed payments. Maybe you've got a silent partner who doesn't do much in the business, isn't going to take any payroll or reasonable salary or guaranteed payments. Then they would have nothing in the guaranteed payment line, and you would be the only one with the guaranteed payments that are out there. Now, real neat thing with guaranteed payments, sometimes you're getting compensated for the equity you have in the business, and you may see a silent partner getting some guaranteed payments for capital. Those are not subject to self-employment taxes at all. It's just a guaranteed payment coming to them for the capital they have in the business. maybe you have it structured a little bit that they're going to get some reward for putting up capital out there that's over and above what they're going to get from their equity line. So you can use this in many different ways to lower the tax burden for the partners of the partnership and reward the person that's doing the most work. A lot of times we see in these partnerships that partners kind of get upset that one person's working more than the other. One's doing more for the company than the other one does. Using these guaranteed payments can help lower that anxiety sometimes between a partner as well, that it kind of calms things down. A few years back, we had two partners, and one was pretty much in sales. One was in the finance side of the business and keeping track of the records. The sales guy kind of was getting upset because he was making all the money for the business. And the finance guy was a little upset because he was actually guiding the financial side of it and trying to keep him on the straight and narrow. So the way we ended up working this out was helping them set up a compensation plan where the sales guy was getting compensated for his sales, and then the finance guy was getting fairly compensated for his role basically as the CFO, Chief Financial Officer of the business. And it was able to calm things down between the two partners and keep the business growing at a very high rate. And they were very, very successful in running their business this way. And it worked out really, really well. Now, again, what you're going to get from this partnership is going to be that K1. And again, you're going to be taxed for the net income of the business based on your percentage of ownership. So if you owned 50%, you're going to get 50% of what the net profit was from the business. Now, you're going to be taxed whether you're an S Corp getting a K1 or you're a partnership getting the K1. You're going to be taxed at the personal level, whether the company distributed all the profit or not. So if the company netted 100,000 and only distributed maybe 30,000 out to all the partners, which means if there were 10 of them, you got 3,000, you're still going to be taxed on that 100,000 divided amongst all the partners. So there may be a huge difference between what is distributed versus what has been taxed. So just because you didn't receive the money, it doesn't mean you're going to be taxed for anything less than what the K1, the net profit, your portion of the business income is. And that goes for both the S Corp and a partnership that is passing out a K1 to each of the owners of the business. Now, an 1120 is they're going to pay its own tax at the corporate level, and then you will only pay the tax on what is a dividend to you or payroll to you. So that is how the taxes are going to be passed through to you as an owner of one of those two entities. We're going to take a short break. When we come back, one of my most favorite topics, and we get the most questions from, is estimated taxes. Who, what, why, when, and where should I pay these taxes to? We'll be right back after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools at 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, Here's your host, Barry G. Fowler.
Hey, welcome back. I just want to welcome a lot of our trucker friends out there that are joining us on the radio program today or listening to us here on podcast. Matter of fact, you can connect with us at taxtalk4u.com and get to our podcasts. We're also on iHeart and Odyssey. You can find our podcasts there as well. So if you're a trucker and you're out on the road, hey, connect with us there, stay up to date. We write for a great magazine for truckers within Owner Operators Independent Drivers Association, OOIDA, Landline Magazine. We wrote a great article a few months back about estimated taxes. We're always keeping truckers up to date on what's happening with taxes for them. We've written an article about tax planning, of course, estimated taxes, corporate taxes. We've got some great articles coming up as well for you, a trucker out there specifically. But even if you're not a trucker, these are some great articles. So check it out at Landline Magazine, Landline Media. And you can see some of the articles that are out there that it's great for self-employed individuals as well. But we're talking about estimated taxes. Now, we get these questions all the time. Who, what, why, when, why should I pay estimated taxes? Well, estimated taxes, let's just be very clear. When you're self-employed, estimated taxes are kind of like those taxes they pull out of a W-2 employee's payroll check. They're prepaying the taxes. The nice thing for the IRS, when you're prepaying the taxes, it's almost like you didn't feel it. You don't notice those taxes after a while coming out of your check. When you're just coming out of, maybe you're coming out of college or something, and you get your first W-2 job, and you go, hey, I'm going to make, $40,000 a year. And the next thing you know, you're looking at it and going, oh my God, they took out how much out of my paycheck? Well, when you're self-employed, nobody's paying those taxes in. You're going to feel the pain when you've got to make those estimated tax payments. And when you first get started in business, many people don't tell you, hey, you need to make estimated tax payments. And so we get these questions every year, a lot of times with our new clients, do I have to make estimated tax payments? The United States system is strictly a pay-as-you-go system. So what it means for you as the American taxpayer, to put it simply, the IRS wants you to pay a sizable portion of what you owe in taxes each year, quarterly throughout the year, and definitely before the tax deadline of April 15th. So anything that you have due, whether you made it in estimated tax payments or not, has to be paid, by April 15th, or they're going to hit you with penalties. Now, again, as a W-2 employee, all that's being withheld. So Social Security, Medicare, federal income tax, state income tax is all withheld from your check. So you now, as self-employed, have to do the same thing. Those employment taxes are, meant to make sure that you've had enough money pulled out of your check to pay your taxes. And so the IRS has set that system up. And the real funny part I always find is that if we all had to pay our taxes in like estimated taxes, nobody would love anything about taxes whatsoever and would realize that everybody is overtaxed. Yes, the government needs money to run, but when they're taking money and giving it places and continuing to tax you and run into debt that you and I couldn't have, you could see what the issue is out there. And so you could see where people that are self-employed don't really enjoy making these estimated tax payments. And sometimes it's really hard. But you, as a sole proprietor, as a partner of a partnership, as a S corporation shareholder, you generally have to make these estimated tax payments if you're expected to owe more than $1,000 when your return is typically filed. Now, they really don't mean owed, but they really mean is the tax is going to be $1,000 or more. Now, when you're figuring up your estimated taxes, there are multiple ways of doing this. The first way is looking at your 2023 tax return. And what was the tax? And so we'll start with the tax. We're going to start, let's say the tax was $20,000. Let's say your husband or wife are on W-2 and they're going to have $10,000 withheld for federal income tax from their W-2. You now have $10,000 that you should be paying in estimated taxes. That's the difference between the two. That can be divided up over quarters. And so you pay, basically April 15th, June 15th, September 15th, and January 15th. Yes, it doesn't sound like real quarters to anybody, but it is the IRS's estimated tax payment system when they expect those payments to be made. So that's going to be a quick, easy method out there that you would go through and file it. Now, the IRS has other requirements. We're going to kind of walk through some of those here as well. But that's a quick, cursory way of looking at it. Now, you can also go to the actual method. So how do you actually earn your money, your net income? So some people may have a cyclical business and that the first part of the year, they don't make very much money, so they don't have to pay. Maybe they don't do anything but break even, or maybe they lose money. So they wouldn't pay any estimated tax with that first quarterly estimated tax payment. And maybe the second one, they don't make very much. But the second and third and fourth quarter, they make a lot of money. Then they will pay most of their estimated taxes towards the end of the year. Maybe you're an S corp. Now, see, this is why we tell you a lot of times to consult a good tax professional, because you want to design the program around how you're making your money or how you can pay it in, or maybe the best way of paying the taxes. So now maybe you're an S corp and you've got to have a reasonable salary, right? Well, if you do a bonus in December and pay it all towards your federal taxes, you don't have to pay it all throughout the year. It's considered to be paid equally each month throughout the year, and you can avoid maybe the estimated tax payments out there. So there's a lot of techniques in doing this. Now, there's other formulas in the estimated taxes. There's one where it's fairly straightforward. You either need to pay 90% of the current year's tax or 100% of the prior year's taxes, whichever is less. So if your annual income is above $150,000, then your second option is to pay 110%, not 100% of the prior year's tax. Whew. We get a little complicated sometimes when we start sitting down and looking at what these estimated tax payments are. So you've got to sit down and you work with a tax professional to make sure that you're doing this right and to avoid some of the tax penalties that are out there. And we're going to talk a little bit more about calculating estimated tax payments, estimated tax penalties, and what do you do if last year you didn't pay your taxes and now you got to do both, pay the taxes and estimates as well. That's going to get complicated throughout the year as you're addressing your estimated taxes and making sure that you're doing things right. I kind of jumped ahead of where we're at in time. So we're going to hopefully take a quick break right here, and we'll be right back after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. I got a great question from one of our trucking friends out there, Joey. He asked, where do we pay these estimated taxes in, and how do we pay these estimated taxes in? Well, you can use the form 1040-ES and send a check in. Then if the check clears, then you've got proof that you made your estimated tax payments. I always tell people, if you're mailing something to the IRS, make sure you send it certified mail so that you know that they've actually received it and they received it timely, and then it's recorded on your record out there. You can go online to the irs.gov and you can pay your estimated tax payments right there online. And then you've got a track record in your bank account or your credit card. They will charge you fees to do this. Of course, you know, most people are charging a transaction fee. The IRS is going to do the same thing. But then, you know, you've got that estimated tax payment made as well. So you have those options out there for you. And again, to know the IRS has got it, you're going to see the item cleared through your bank account. You know, check your bank statement, check your credit card statement, however you paid it, and make sure that transaction went through. If you're making that estimated tax payment on, let's say, April 15th, the first one of every year, make sure they credit it to the right period, the right year, because April 15th, you usually have two options, and that is to make the estimated tax payment or pay on the prior year's taxes as well. We've had people that have messed up, and instead of making the tax payment on the prior year, they doubled up on their estimated tax payments. And that's kind of easy to fix. You can call the IRS and ask them to take that payment and move it to the prior period, and it would get credited the right place, even if you messed up. The IRS will do that as well. The other question we get coming in is, what happens if I don't make the estimated tax payments? Well, we're going to cover two parts of this. So you're filing, just got done filing, let's say your 2023 taxes, and you owed a whole bunch of money on those taxes, but yet you're having trouble making this year's estimated tax payments. Well, the first thing we're going to tell you is to pay your estimated tax payments to avoid the little bit of penalties that they're going to have, because the IRS will assess a penalty for not making your estimated tax payment. They will then assess interest as well from when that estimated tax payment should have been made. And what happens for like 2023, where you're filed right now, they're already going to charge you a penalty for not paying the tax and interest all the way up to the date that you filed, and then continuing on from there. Well, let's keep you out of hot water. Let's make the estimated tax payments right now and work on a solution to either put a payment plan in, or maybe an offer in compromise, or maybe a non-collectible status, depending on how business is going. Put some kind of solution in place to keep the IRS at bay in dealing with your taxes. Now, we've dealt with many small businesses and many truckers out there across the country. And in dealing with them, many times you've started in business, but nobody ever told you you needed to make estimated tax payments. And that gets you in trouble. And that's why, whether you're working with somebody like me, working with truckertaxtools.com or Taxation Solutions Tax Relief, get advice. Ask them about the estimated tax payments. Now, we're going to tell you two things. You in business should be making them. You being in business, if last year's net income was such that you don't have to make them, we're not going to ask you to make them, but we are going to tell you to put money aside for next year's taxes. So, you use kind of a good judgment. 20 to 35% should be set aside of your net income to possibly pay the taxes for 2024, and have that set aside into an account. And hey, we tell you, you might as well earn the interest on your money. Dave Ramsey will tell you the same thing. You should be earning the interest on your money. You should be only paying in the minimum required by law to the IRS and saving the rest, because now you've got the money to continue to make more money for yourself and not have the money sit there at the IRS, and they're not going to give you money back. They're not going to pay you interest on the money that they have sitting there. They will give you a refund of your money, but that's all they're going to do. Now, if it's a year or two down the road that you actually file your taxes and get that refund, yes, they will pay you interest on that money, but it's still less than what you would have made if you were taking it and investing it yourself. That's out there. So general guidelines would be taking and setting aside, 20 to 35%, because you've got to remember, if you're self-employed and filing on Schedule C, you're going to have self-employment taxes. If you're a partnership and have guaranteed payments, you're going to have self-employment taxes. If you are a S Corp, you're not going to have the self-employment taxes, because you'll be a W-2 wage earner for the S Corp. And so therefore your amount you're going to want to set aside will be closer to that 20%, so that you're holding the money out there. If the company's not making distributions to you as a S Corp or as a partnership, it's going to be a little bit harder to judge, but you want to see financial statements from your partnership or S Corp, so you would be a little bit more prepared for what's going to hit you as a owner of the business. And so you need to keep those things in mind. Now, in making estimated tax payments, people ask this all the time, is can I pay out all at once? If it's in the first quarter, yes. We don't recommend it. We recommend that you break it down and pay it over the 4 quarters that are there. But yes, you can. You can also roll over your refund. So if you filed your 2023 tax return and get a refund coming back, you can roll it over into your estimates for 2024. And you could have it count for each of the vouchers or estimated tax payments you got to make throughout the year until it's used up. A lot of our bigger clients that we deal with, they may have a large refund and they will have it credited towards all of 2024 to make sure that they've got everything covered, but it will take the place of any estimated tax payments they would have going out there. So they do that, and that's available to you no matter how big the refund is. But your tax preparer should also be sitting down and giving you advice on what should be done. Now, can you avoid making estimated tax payments? Absolutely, there is a way. If your spouse is employed, they could pay more in federal income tax or state income tax from their W-2 job, so you can increase their withholding. So if you need an extra $10,000 or let's say $12,000 a year, you can have an extra $1,000 come out of their W-2 payroll every month, and then you could avoid paying those estimated tax payments as well. If you didn't owe anything or no tax, you wouldn't have to make any estimated tax payments for this year. But that being the case, you want to monitor how well you're doing through your financial statements to make sure that what is going to be the net income for you is going to pass through. So if you're Schedule C, you still want financial statements so you can see where you're at and how you're doing and how your business is doing, and then determine how much tax you're going to be paying as well. So you sit down and do tax planning. Something we're doing for a lot of the truckers that work with us at truckertaxtools.com We're sitting down and doing tax planning for them right now. Yes, we just finished tax season. We just finished filing taxes here for October 15th, and we roll right into continuing tax planning to where we're sitting down and doing an estimate of how much you're going to owe as an owner operator, whether you are, again, S Corp, C Corp, LLC, or partnership, or sole proprietor. We sit down and look at how much that you're going to owe the IRS based on where you're at today, taking into account everything from all your income and expenses. We enjoy doing this because all of our clients that are bookkeeping clients of ours expect this and expect to be able to sit down and do these things and talk about how much money they're going to owe. And then we can run our proprietary software that we've got that does our tax minimizer, profit maximizer, and what's going to be best for them in the way we do things. And once we get to that, we make sure that they've paid in enough in their estimates, that they've set enough money aside to pay the tax that possibly could be due, or get the good news is they're going to pay less than what they think they're going to owe, or less than what they owe the previous year. We also be able to come back and say, hey, most truckers out there and a lot of self-employed people don't ever think about is retirement. How much money they should be putting away for retirement, and when they're going to be getting out of business, whether you're an owner operator, whether you're self-employed, and let's say even construction, whatever you're doing, you need to know what the end game is going to be and how you're going to be able to retire and set money aside. And people don't talk about that enough these days. They're going to talk about taxes. They're going to talk about, tax forgiveness. They're going to talk about how to make a lot of profit, but how to set it aside for your future as well. And those are some of the things that we get to talk about when we're sitting down and doing tax planning. How should you depreciate an asset? Do I take it Section 179? Do I take a bonus depreciation? Do I take it over 5 years, 3 years? What period is it? But that's the importance of tax planning. And that tax planning comes into making these estimated tax payments and making sure that you've paid enough in and not too much in, and maybe have enough money set aside for those taxes. Now, make sure that when you're doing estimated taxes, you got to take a look at what state you live in. If you live in the great state of Texas, we're not going to have estimated taxes because we don't pay state income tax. But your income may be high enough that you might be paying franchise tax. Do we maybe slow down, income so that you don't go over to where you'd be having to pay that tax? If you live in a state like Pennsylvania or Ohio, are you paying, what are your taxes that you're paying into the state? And you've got to take into account estimated taxes for that as well, such as even New York or New Jersey. Some highly taxed states, California, of what taxes you're going to have to pay, and you need that into the computation as well. That's out there. Now, every individual situation is different. Get a good tax advisor. Get a good enrolled agent. Get a good bookkeeper, whether you use us here at truckertaxtools.com or whether you use somebody else. You need somebody to be able to bounce ideas off of, to talk about the tax aspect of your business. Is being a corporation, C Corp, S Corp, partnership right for you? That takes tax planning. That takes a little knowledge of your business, a little knowledge of what's happening in your life. How can we change things to make things better for you in helping you down the road? Now, next week, we're going to talk about the IRS and your tax debt. So make sure you're here next week to talk about your tax debt, what can be done, how can you do it? Can you do it alone? Do you need help? Where do we need to go from there? Hey, I look forward to seeing you next week. Connect with us at taxtalk4u.com or out there on Facebook and iHeart, Odyssey. You can find our podcasts in many places. And I look forward to you being here every Monday at 10 o'clock Eastern Time. Join us at taxtalk4u.com. Thank you. Have a great week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalk4u.com. See you next week at W4CY.com.